Okay, well let's go ahead and move to the valuation report itself. So I'll give credit to Jacob for having put this together, and I've only added to it maybe 15 or 20% at most, and I appreciate Jacob for doing that. So the valuation report should have a title. Jacob is saying slide here, but think of title page. This is going to be a report that you also do as a presentation. So you'll be translating these into both media, right? So you're going to have a title page. You may have a graphic that you choose to develop for your company. You may not. I'm not too concerned about that, but obviously the more interesting it looks, the more interested I'm going to be, and you want me to be interested in these things, right? And that should include, of course, the name, the date, the company, and such as to, but your basic title. Here you see on the right-hand side the title slide for UVal's presentation report, and we do in UVal we do the evaluation report as a PowerPoint presentation. It doesn't include everything that you guys are going to be including, because we are understandably and admittedly not doing these as fully professional valuation analysts. So there's a few things that report does not include that you will be including in a full valuation report. But here's just an example of what we've given. Here's another example of one, and you guys know that you have online in the valuation report module 6 or 7 different examples, and this one is the business valuation report example. It's called the BV report. What we've had, Jacob's kind of taken this one from at my request. So from there, we expect to see a table of contents, and I'm not giving you exactly the same table of contents here that you'll find in that BV report. In fact, let's go to Canvas for just a second, because I want to make sure you see exactly where I'm getting that. So if we're in the modules on Canvas, and we scroll down here to, where's it at? Well, okay. Did I miss it? Yeah, excuse me, right up here, Valuation Report Templates. So it's under Models, Templates, and Primers. It will then take you to this page. And this item right here, Sample BV Report, is the report essentially that you're about to look at. It's not as long as some of these, but a little bit longer than others. It's not as comprehensive as a couple of them, but it's more comprehensive than others. I think it's laid out well. I would recommend it. I would think that you can use some of the material that we've developed for UVal as well, but again, they're not going to be as complete as I expect this to be. Those are for a different purpose. So this is a sample business valuation report, which is what Jacob based this off of at my request. And when you look at the table of contents of that report, which I believe I have right here, let me go to it, bring it over. When you look at the table of contents of the report, you're going to see that it is largely structured the same as I've structured this valuation report contents. But I've added a few things here that I'm going to expect you to pick up, such as the presentation of the financials, cap table, stock option pool, and I think there's a couple other things as well. So when you look at that sample report, don't only use the table of contents that it has to inform what you're putting in your report, but use the additional elements as I've constructed them here in this slide that Jacob's put together for us. And so we're about to walk through each of these highlighted sections, not in fine detail, but I believe with enough detail so that you can understand how you take what you've already done, or the kinds of things you've already done, and translate those into a respectable valuation report. Let's talk about professional reports in the valuation sector for a minute. You guys, and to do that, I have to talk briefly about some of the different accreditations in the valuation industry. Have any of you looked at the different types of accreditations that are available within valuation? We're going to talk about them more rigorously on the last day of class, so I'm not going to go through that very much right now. I'm going to tell you about the different accreditations on the 28th, our last day of class, plus I'm going to go through and help you see where you might access if you're at all interested in how to do the training for those accreditations and such. There's really rather a lot out there. And I will tell you right now, some of them are eminently credible. The two most well-respected come from ASA, the American Society of Appraisers, ASA, and from the AICPA, American Institute for Certified Public Accountants. So those are the two most well-respected accreditations or designations in the valuation industry. Commensurate with their respect, they're not easy to get. Up until December of 2018, you had to be a CPA in order to get the AICPA designation as a certified valuation analyst. But starting December of 2018, you no longer needed to be a CPA. And you don't need to be a CPA to get the ASA designation. And the ASA designation is Certified Senior Advisor, I believe. And it comes from, so it's the CSA, Certified Senior Advisor, and it comes, I think that's the designation, but it comes out of the ASA, the American Society of Appraisers. In the back of my mind, I'm questioning that whether it's CSA or another acronym now for their designation within the ASA. Regardless, these designations take some doing. In fact, they take more than a couple of dollars to get. If you went through the AICPA program, you're going to spend a few $1,000s and probably spend 3 or 4 months worth of study on a full-time equivalent. So if you're not doing it full-time, you're going to study for it for probably a year or so. It's designed to be as rigorous as the CFA. It doesn't take you as long to get, but it does take you a number of engagements. You've got to evidence some activity as well. So I'm telling you all of this because those are at the top of the heap, the most credible. And then you'll find a few others that are less rigorous, less well-respected, and then you're going to go all the way down to a designation that you can get for about $300, maybe $400. You could spend a couple of good weekends studying for, and then you could be a certified appraiser. And in fact, it's a certified valuation analyst, a CVA, is this designation out of the NACVA, National Association of Certified Valuation Analysts. That is the easiest designation to get. It's the least expensive designation, takes you the least amount of time, and it's the least respected of the designations. You guys would learn very little in going through that process of getting that designation. You'd learn some, but you'd learn very little going through that process. Ironically, the organization that hosts it is in Murray, Utah. NACVA has their national office in Murray, Utah, and they have thousands of advisors and a certified valuation analyst. Unfortunately, many of their valuation analysts only got the designation so that they could have this and they could use it as a marketing tool. And there's a lot of valuation work done out there that's not terribly credible. You'll find people that put on seminars that will charge prospects several $100s to come to teach them about the valuation. Then they will go through and try to do valuations for them at the tune of either several hundred or a few $1,000s, and they won't do nearly the kind of job that you guys are doing. Those people make their money in a different way than the Jeff Pickett's, Zach Nugent's, and Bryson Lords of the world. So there's a whole range of these out there, and the reports that come from some of them represent a big range as well. Everything from a white paper that's not very meaty to a valuation report that's well over 100 pages long. And what I'm showing you is not middle of the road on these. It's in the upper quartile, if you will, but it's by no means some of the less credible ones. So this table of contents, we're going to walk through some of the different elements here for a few minutes, but I'm going to refer you back to this as you're thinking about putting together your report. So let's continue on here. So the first thing that we see in this report is a conclusion of value. And the conclusion of value is actually a letter that you create to the company, and then you include in this details, just exactly as you'll read here. It's a little bit of an introduction, as if you will, that tells the company the value that you've assigned, how you got there in just very broad brushstroke, the date that valuation is assigned as of. It gives a little bit of credentialing, and then it's signed off. This becomes the document that is often then used as evidence when people are having to show the IRS or some other fiduciary system or the legal system the valuation number, the dollar value. So the very first thing we see after the table of contents is this conclusion of value, and it's a letter that is telling the client, here's who we are, what we did, the value we ascribed to your company, and the date that value was assessed as of. And we've signed it as these eminently credible professional valuation analysts. So you're going to create this letter, okay? We then move to a valuation summary. And the valuation summary that you're going to see in the valuation report, that sample BV report, is not quite as fully fleshed out as I would like it to be. So what you're seeing here on the right-hand side of my screen is what you'll see in that PDF that you'll pull in Canvas. And you should identify these things. You're going to see there's some redundancy between what we've got right here and what you had in the letter. But there's also some additional information. How are we thinking about this? We're going to think about, where are we representing ownership? What valuation methods do we do? This is an uber high level executive summary, if you will. Not a lot of detail, just big bullet points, but cover all of these points. But I also want you to cover the present value per share of the common and the present value per share of the preferred. So you're going to have to come up with a valuation. You're going to have to then work that valuation to an equity value. And then you're going to have to work those equity values to a per share value of common and a per share value of a preferred, assuming there is preferred to value. Okay? Is there a difference between the per share value and the per share price sometimes? So Pat, I'm going to give you a second to come off of mute. You're looking at the market today at Tilley Enterprises, and you're a happy guy. Even though the market's been going to hell in a handbasket around us, it's had a couple of nice days like yesterday, you realize that today Tilley Enterprises is priced at $36 a share. In fact, you're giddy. Part of the reason you're giddy is because Britton walked into you yesterday knowing that you were very concerned about the value and price of the company, and he provided you with a valuation estimate that showed, based upon valuation metrics, the firm's only worth about $31 a share. So there's a difference between price and value, isn't there?
Yeah, absolutely. I think depending on who you are in the company or like if you own shares or not, it can be a good thing if you are undervalued, or it could be a good thing if you're overvalued. Yeah, I'm not trying to think.
Well, let's talk about that for a minute, because I think it's a really good point. So let's assume that your valuation came out to about $31 a share for your common stock.
Yeah.
But your price in the market, the way that economic agents in the market have perceived you and the trading activity has given you, is $36 a share.
Right.
Does that bother you as a business owner?
As a business owner, I think it's tough because I feel like you always want your stocks to your value to be higher, as high as
Okay.
possible if you own a lot of shares in that company. The only concern, I guess, would be, are you going to be able to back it up going forward
Yeah.
uh, with actual metrics, not just like the price of your stock?
So Kira, I'm going to have you come off mute here. I know you're an investment banker and you do some consulting and some service work for Tilly Enterprises. In fact, you worked with Britton as he put together this valuation. Okay. As an investment banker, what do you think about the fact that the market is pricing Tilly at 36, but you and Britton can only justify a value of 24, or excuse me, 31?
I think it depends on who you are. It could be concerning if like later
You're
down
the
the road.
investment banker. That's who you are.
Yeah. I think it'd be a good thing just because you're getting a higher price for something.
Okay.
But I mean,
Okay. No, I tend to agree. I mean, you kind of like it in that you see the market is ascribing to you a greater price than you realize the company has a value. So that means the market has either some activity that is affecting the price, or the market thinks it knows something you don't know, or market agents have a different discount rate than the company's discount rate. Something else is going on here, right? For that disparity to exist. So Britton, I'm going to let you come off of mute here as we talk about this a little bit. You're the CFO of the company. You worked with Pat on this deal. Do you have any concern?
I think it could, like you were saying, it could be a good thing because it could reflect expectations in the market of your company moving forward. But then in terms of it being a bad thing, it could be like being overvalued could put you at risk for potential downside in terms of
Yeah.
Yeah.
So I'm the chairman of the board, Pat. You're the president. I'm the chairman. And you know that the board has a singular job as it pertains to staffing for the company. The board hires the CEO. And the board may set some vision and direction as well, but the board has one singular management responsibility with respect to the company, and that is to hire the CEO. All other management activity is the purview of the CEO. And you know, as a board member, and the rest of us, Gerson, Logan, and Alex, and all the others, Mason, etc., Griffin, we've all got shares of stock. That's why we're on the board. And we're happy that it's at 36. And I know its value is at 31. What's the greatest likelihood? Will the value rise to the market's price, or will the market fall to the firm's value?
I think the market will fall to the firm's value eventually. So I think you'd probably want to try and play some catch up.
Yeah. In fact, I think the term is run like hell.
Run like hell.
Yeah. In order to try to get this firm's value to approach what the market price is. Otherwise, you're exactly right. You're going to see a price return or price convergence to the value, because the market, the value and the price really shouldn't have a meaningful disparity. Whatever asymmetry or anomaly exists in the market to cause that to be upside down somehow will cure itself. So think about why people go out and do value investing or try to buy undervalued stocks. They buy them because they believe that they're going to come up to what they should be priced at in the market. Okay. So I want you to do this kind of valuation summary. Now, you're not going to be comparing, a price per share summary. You're not going to be comparing this value per share to a market price necessarily, because I don't know that we know market prices. Now, some of your companies, I think you may have had a market price given to you in your cases, but I don't believe that, I'm not sure that's the case for any of them. But if you do, you can do that comparison. But if you don't have the market price, then there's no reason to try to do a comparison here in this valuation summary. Okay? Any question about this so far? Okay, let's keep going on then. Well, we're now going to move to the company analysis. And the company analysis really is fairly lengthy if you actually think about it. But what it boils down to is I want a good description of the company. I want to know the overall business and the economic research. So this is where you're going to put in industry research. This is where you're going to describe the company. This is where you're going to include macroeconomic data as to what's happening in the market today. Remember, the company affects itself by its decision makers and what it decides to do. But the industry affects it as the industry goes through various gyrations. But the overall market, the macroeconomic environment, which may be very local to everything, very global, affects it as well. So this is where I want to see that kind of analysis. Now, here's something that I would encourage you guys to do in collaboration with each other. I would encourage the two of you that have DDD, the two of you that have Tech Hub, etc., to collaborate in terms of the company analysis descriptions. And so I'm not going to have any problem at all if the two DDD people have very similar descriptions, economic condition discussions, industry discussions. Won't bother me in the least. In fact, the overall macroeconomic discussion could be the same discussion used by all of you. So if you want to, as a class, collaborate on that, because the one Gerson uses for the company he deals with, the one that Mason uses for the company he deals with, are in the same macroeconomic global situation and national situation, and even it may be a state situation, okay? So feel free to collaborate on those so you're not all having to do the same job. So we don't overlap more than is necessary. But make sure that what you present in your material has clearly your spin, and if you think that the collaborative output, it doesn't say everything you want it to, feel free to edit it, of course. And if it says more than you think it should, feel free to edit it. But collaborate on this. And I'm going to leave that up to you guys completely. I'm not going to get involved in that any further than saying, I think you're smart to do this, and I think you should do this. I'm going to leave it up to you as a group to become efficient managers. So this is where you'll have all of that discussion. And I should leave the company analysis knowing pretty much everything I can know about the company. Now, some of this has been given to you in the material I gave you, right? And some of this you've since developed with respect to industry and such. But this should be just a good introduction to the company and the market and condition it finds itself in given the industry and the macroeconomic climate. That said, I don't believe that you should flavor this macroeconomic discussion with the gloom and doom of COVID, the era of COVID-19. But if you ignore this era, then you're similarly naive. If I were doing an analysis today, I would be looking at the macroeconomic environment as it existed in January with respect to markets, interest rates, expectations of growth, fear of recessions. I would look at the whole thing as it existed in January. I would then have towards the top of that discussion, I would note that macroeconomic conditions have changed dramatically in recent weeks. And it's difficult to determine at the moment whether or not that change is persistent and will be with us for years to come, or if we will very quickly emerge from this. We just don't know. We're clearly either in or will see soon a recession, right? I don't think there's any question in virtually anyone's mind about that. But it's not going to be a run-of-the-mill recession, if you can call recessions run-of-the-mill. We will have entered into it like falling off of a cliff much more rapidly than any other recession that I can even think of well enough having experienced. And because we've never entered into one like this, that's, except for maybe 1917, when we had the Spanish flu, but we didn't understand macroeconomics to the extent that we do today. We didn't have the instruments, we didn't have the reports, we just didn't know what we didn't know 100 years ago. We don't know what coming out of this is going to look like either. It is conceivable that we will take a long upward slope out of this that could take 5 to 7 years. It's conceivable that we'll turn around in December of this year and look back and say, what was that? And I'm so grateful that we've returned to normalcy. And we just don't know what's going to be in the middle of this deal. So I would do this as of January. I would then give a paragraph or two discussing the current condition and indicate that this valuation that you've done is not going to be reflective of much of the current condition, but that a prudent buyer, seller, firm owner needs to know that the uncertainty that the current condition has caused has led to an uncertainty as the accuracy of the valuation given today's climate. Does that make sense? So don't ignore and do disclaim and disclose. You might even choose to have a little bit of rhetoric with respect to that in your letter, but I don't want your letter going more than a page. Okay, an executive summary of this type, accreditation of this type would not go more than a page. Okay, any questions? All right, let's move on. So then in this report, I want you to do the presentation of financials. And in here, you're going to give us a little bit of text with respect to the financials that you received. And then, you know, you're going to then give us some graphic display of how you compose those into either a forecast panel or how you forecast the incomes, expenses, and such, what you did with that to get it to a point where you used it in the valuation. You won't go through and give us every tiny detail of balance sheet, every tiny detail of income statement. You will give this to us in 2 or 3 pages all in, okay? But you've got to give us a sense, a numeric visual sense of the current condition of the company and some of where you are going forecast-wise. And so, and you'll include in these your cash flow adjustments. And I would make sure that your cash flow adjustments come in as adjustments before EBIT. So you'll be representing that these are not necessarily audited or auditable financials. They are the financials given to you that you then used or you morphed to use for your valuation. Now, Kira's looking at this and saying, Rick, you're going way far beyond what we might have done in evaluation competition and such and using a UVal-like structure. And you're right, Kira, but we have different purposes for these, okay? I next want you to go in and start to talk then about the stock option pool. And again, we talked about this a few minutes ago. We were talking about Black-Scholes. You're going to be discussing the existing stock options, providing value for them. You're going to look at the hypothetical granting of stock options in a pool. You'll go through the option pricing model. You'll represent that model and its outcomes. And you'll talk to us about the effect of those options have on the firm and the stakeholders. And the effect it has on the firm is aligning the interests of the firm to the shareholders, the stakeholders, workers. It probably has some effect in terms of dilution. The effect it has on the other stakeholders is, again, this alignment issue and being a bit of a carrot sitting out there that we can be working towards to give ourselves some of the multi-millions of dollars we think we're going to get when our stock options are exercised. So you're going to walk this through in a discussion. You're going to walk this through by some graphic representation of some numerics and give us the numbers that come out of the model. I don't know that I would give us all 6 columns of data that Logan and Alex gave us in that complete worksheet in the Black-Scholes model, but I would give us much of that. In fact, I believe I've posted for you online a version of that model where I did some editing of it and included the definitions for each of those gamma, sigma, alpha, beta, etc., that are oftentimes referred to as the Greeks. So you've got some text in there so you can understand what each of those is and put it in perspective and relevance. So I believe I posted that in Canvas for you. I'll check and make sure that's been done. But this is where you're going to give the discussion of your stock options, the utility of the Black-Scholes model, find the prices, and the option pool. You're also then going to give us the cap table. You know how to give us a cap table. It falls after the discussion of the stock option pool because the stock option pool is going to influence the cap table, right? As are existing stock options that have already been granted. So give us the cap table exactly like you know to give us your best cap table. Then start to work into valuation methods. Which methods you're using, you're going to introduce them one at a time, and why this method is or other methods aren't necessarily used. So let's think about these. It's going to include an income approach. It's going to use a market approach, so multiples. Income approach is going to be a DCF of some kind. Market approach is going to be multiples based. And then it's going to include an asset approach. And so I think you pretty well understand what we're expecting out of the income approach, right? You're going to have to think about identifying discount rates. You're going to have to think about identifying growth rates in an explicit period. You're going to have to think about identifying a long-term growth rate to give evaluation to your continuation period and how this all morphs into a value. Now, in fact, using that one model, you might have used a couple of different levels of the variables. In fact, you might find 3 different value outcomes. And you're going to have to determine how you represent those and which of them will you use. Will you rely on the one where the discount rate was 7%? Or will you bracket that discount rate so you do one at 6.5%, one at 7%, and one at 8%? Because it could just as easily be 6.5 as it could be 8 or 7. You don't know, so you're putting some judgment in here, right? But give us the outcome of your income approach and come down to an income approach model and an income approach value. You can use free cash flow model or an SDE model, or you can use a blue sky-like model if there's meaningful tangible assets. In fact, you should use a blue sky-like model if there's meaningful tangible assets, right? I don't think I'd use an economic profit model. I don't think I'd use a KVD model, to be honest with you. But I would use one of those 3. Okay, and they have some commonalities to them. Okay, so the next one then becomes the market approach. You know how to do market approaches already. You're going to give us the comp. You're going to find the comps. You're going to give them to us in a table. You're going to show us how you broke them down. You're going to show us why you used the comp you did. You're going to show us maybe a range of comps, all of this. You've already done most of this work, right? Like you've already done virtually all the work, I'm going to guess, on the income approach. And you may have done all the work on this one. You're just going to take what you've done and package it in, slot it into this master document that you're now creating. Make sure as you do this that you've got good flow going from one section to another. If it's obvious to me that you're simply taking something from one kind of a document, putting it into this, you're taking all these disparate parts and putting it into this thing, and if you don't have your text structured such that it flows, if you don't have the visual structure such that it flows, then it's disjointed and it's not very professional. So go ahead and use items that you've already created, put them into this master tool, but make sure that you morph it so that it flows well, so that it obviously looks like it goes together. Okay? And then finally, you'll give an asset approach. The asset approach is maybe not the way an asset approach might be handled in all valuation reports. In many valuation reports, the asset approach will be taking the assets on the balance sheet and trying to ascribe a reasonable market value to each of them or each group of them. Well, that's easy with real estate, right? It's harder with equipment that's been depreciated, and it's not something that I necessarily expect you to do in this. But sometimes we will make the assumption that the firm has been using mark-to-market accounting such that the assets on the balance sheet are already at their realistic market value to the extent that one can be ascribed. and then use that information to bring us to a point where we understand the value of the tangible assets and the value of goodwill. Because together, those are the value of the assets, right? And again, you've also done this work fairly recently as well. You might be updating this, but you know how to do this work. You don't need to take this to a per share value. This is where you're going to be identifying you will have identified equity from your valuation that you gave the firm, and you'll take that valuation and reverse it to equity by taking and subtracting from it debt, adding to it any surplus cash, and that's going to leave you with the equity involved. That equity is owner's equity. And owner's equity and liabilities should equal then tangible assets and goodwill. And that's how you're going to determine what goodwill is. And again, you've already done this. So this is where I'm expecting to see this discussion and these numbers. Any question about the asset approach structure? I think you've already been here. I just want to make sure that you're comfortable with it. Okay, then you're going to go into evaluation summary. This is kind of like a second conclusion. This is where you're going to show us how you took these three disparate values, perhaps, or disparate ways of looking at value and put them together. Well, you're probably going to ignore the asset value because you got to the asset value using the using the valuation. Okay, so you'll ignore it. But now you're going to show us how you use the income approach and use the market approach to get to the valuation. You're going to give us your weights, your structure, your methodology as to how you took those values, those numbers, and got them to converge on a single individual value that you've now hung your hat on and staked your credibility and this report on. And that is the conclusion. That's a summary, but it's also the conclusion. And then beyond that, you're simply going to give us appendices that have every item you used to create this represented. So if you've got the case, you should include the case for DDD or Tech Hub or what have you in this appendix. You should include the financials that we're doing. You should include every item. This would include the full comparable panel that you pulled out of Deal Stats and or PitchBook, and I would use both. I might even think about using FactSet, of course, but again, you've already done most of this work. So you're going to take all of these sources and you're going to organize them into your appendix. You will have been reflecting on the appendix as you're going through the different sections, right? You may not represent everything here in this one for the full valuation or the full panel of comps. You may leave that in the appendix, but in this section where you talk about the market approach, you're going to reference the appendix. So if the reader wants to get more granular detail, they can go get more granular detail. The appendix oftentimes is longer than the remainder of the report. In fact, and this wasn't a valuation report, but it's not unusual proportionally. When I wrote my dissertation, as I was completing my doctorate, my dissertation became a book. And it was 360 pages. But of that 360 pages, well over 100 pages were simply appendix. In fact, I think it was like 140 pages were simply appendix. And almost another 70 pages were tables and output summaries. And so that means that only like 100, or I think it's like 120 pages, if I remember correctly, was the actual text that I had to write as I wrote my dissertation. Well, you're not dealing with anything of that scale, right? In fact, if you're going to, good for you, it'll be a great, very rich experience someday in your life, but you will have put something sharp in your ear at least 3 times, threatening to force it through to the other side. I promise you, okay? So, but proportionally, you may end up with something not altogether different. So don't be afraid if your appendix is getting big. And you don't need to represent or walk through your appendix in the presentation. You do need to walk through all the other relevant and salient elements of the report in the presentation. And you need to confine it to half an hour or less. Okay, any questions? Okay, so I think you guys have some work to do. I'm looking forward to seeing you with Scalar next week. Feel free to hit me with any questions, but get real familiar with this valuation report structure. It is your assessment and your presentation kind of combined, right? Okay. Well, I can't tell if I've just bored you to tears. I can see that for the most part, you're still there, you know? Okay. All right, guys. Well, look, if there's nothing else, then we're gonna step off, and I'll get these things posted for you, including the video over the next day or so. All right.
Thanks, Rick.
Okay. Thank you.
Awesome. Thanks.